We are diving into a topic today with just immense weight. I mean, this is possibly the biggest shift in American finance in a generation.
It really is. After years of watching from the sidelines, really, the United States is closer than it's ever been to passing a complete federal market structure law for crypto.
And this isn't just another small bill, right? It's not just another committee hearing. The sources we have today are clear. This is the first uh, truly comprehensive digital asset framework ever attempted here.
Yeah, they're trying to define everything, what these assets actually are, who gets to regulate them, and maybe most importantly, how customer money is kept safe.
And we should probably just get this out of the way right at the top.
Yeah.
The shock factor in the source material is the politics.
Oh, yeah?
President Donald Trump is widely expected to sign this bill into law. That single expectation basically guarantees the industry is taking this seriously. It's not just talk.
Exactly. I mean, when you've got that level of political momentum,
Yeah.
the train has left the station. This is happening.
Absolutely. So our mission for this deep dive is clear. We're going to untack this landmark U.S. digital asset framework. We need to figure out what it defines, what rules it's forcing on exchanges, and, why everyone's calling it the most important change since the Bitcoin ETFs.
And the scope is huge. It really comes down to four main pillars: what crypto is, who's in charge, how exchanges have to operate, and how you, the customer, are protected.
And this is not some far-off theoretical thing. We have a timeline. Chair Tim Scott has confirmed the Senate Banking Committee is voting on this in December 2025.
Which is right around the corner.
Okay, let's unpack this. Let's start with, I think, the biggest issue, the one that's basically paralyzed everyone for years, which is the regulatory turf war.
This is the core of it. The framework
Yeah.
it settles the score. It starts by officially classifying Bitcoin and Ethereum as digital commodities.
And that one decision, I mean, the significance is just massive, right? It ends that infamous battle between the SEC and the CFTC.
It does. But let's pause on that.
Yeah.
For people listening, why does it matter so much if something is a commodity versus a security? What's the real-world difference?
Well, it's about what the regulator focuses on. The SEC, which regulates securities, is mostly concerned with the issuance. Did a company raise money based on the efforts of others? It requires all these disclosures.
Right, the Howey test.
Exactly. But the CFTC, which handles commodities, is focused on the market itself. Fraud, manipulation, the derivatives trading on top of the asset.
So by calling BTC and ETH commodities, the bill is basically saying they aren't investment contracts that need SEC registration to exist.
It kills the constant threat of some retroactive enforcement action, and it finally answers that question that has hung over Ethereum for, what, a decade?
Is ETH an unregistered security?
Yeah. That question has kept billions of dollars on the sidelines, and this bill seems to say definitively no. The CFTC is in charge.
The clarity is just. It's a game changer for institutions. But I do have to push back a little here. If the CFTC gets Bitcoin and Ethereum, but the SEC still gets basically every other token, hasn't Congress just drawn a new, cleaner line in the sand? I mean, the fight isn't over, is it?
That is a really, really fair point, and it kind of gets to the limits of the legislation. It solves the problem for the two biggest assets, which is, what, 60% of the market?
A huge win, for sure.
But yeah, it implies that almost everything else, all the altcoins, they're probably going to be in the SEC's territory, so exchanges will have to be very careful.
So it's creating a two-tiered system, really. Clear rules for the giants, and then everything else is still kind of in that gray area.
It seems that way, but the source material is pretty clear on this. For the big institutions, this is the clarity they've been begging for. They're calling it the most important change since the spot ETFs.
They can finally build,
Yeah.
without constantly looking over their shoulder.
Right, so that's the clarity part. But this bill is also a direct reaction to disaster. That brings us to the real guardrails that Congress is putting in place, specifically after FTX.
And these are not suggestions. They're mandatory for any exchange operating in the U.S. The law goes right after the biggest failures we saw, and it focuses on three things: segregation, conflicts of interest, and risk.
Let's start with segregation. I mean, looking back, it's just shocking that this wasn't already law. What's the specific rule being put in place?
It's strict. The law mandates that an exchange's own money, their operational cash, can't be mixed with customer deposits, period.
So no commingling.
None. What happened at FTX, where customer money was basically used as a personal piggy bank, that was a failure of the most basic financial duty. This law makes that separation absolute, so if an exchange fails, customer funds are legally separate and protected.
It just sounds so obvious, doesn't it? Don't spend your customers' money.
You'd think so. But the disaster proved we needed it written into federal law.
Okay, so that's one. What's the second guardrail?
Conflict of interest controls. This is to stop the kind of self-dealing we saw. The law forces exchanges to build structural walls between their trading platform and any internal market-making desks they might own.
So how do you actually do that? How do you enforce a wall inside a company?
Through audited Chinese walls, essentially.
Mm-hmm.
They have to prove that their own trading desk doesn't get special access to the order book or see customer data before anyone else. It's about making sure they can't trade against their own users with an unfair advantage.
Okay, so the goal is super specific. Make sure customer assets are actually their assets, and make sure the game isn't rigged from the inside.
That's it. The source says the intention is to make a U.S. exchange collapse like FTX nearly impossible. It's about forcing a much higher standard of operation.
That handles the big centralized players. But now, here's where it gets really interesting. We get to the battle zone. Decentralized finance, DeFi. Because everyone might agree on rules for Bitcoin and exchanges, but DeFi is the real sticking point.
This is where the ideology really comes into play. You're trying to regulate something that is, by its very nature, designed to remove the regulators, the intermediaries.
So let's break down the two sides based on the source. What do the Democrats want to see for DeFi?
Their priorities seem to be about stability and preventing crime. They're focused on anti-money laundering, AML requirements. They want very specific controls on stablecoins because they're afraid a big one could collapse and cause a panic.
And what else?
And reporting rules. They want large DeFi protocols to report activity so regulators can monitor for systemic risk. Basically, they want to make sure DeFi doesn't become a black box for illicit activity or blow up the rest of the financial system.
And the Republican platform is pretty much the exact opposite.
Pretty much. Their priority is minimal interference, light touch oversight. They argue that a lot of this is just open source software, not a company. And their biggest red line is a ban on KYC, know your customer, for non-custodial wallets.
That's the heart of the fight, isn't it? For anyone who's not deep in this space, why is that one issue, no KYC on personal wallets, so important to crypto advocates?
Because a non-custodial wallet is just software you control. You hold the keys. It's like your physical wallet with cash in it. If you force KYC on the software, you're essentially forcing surveillance into a peer-to-peer system.
You're reintroducing an intermediary.
You are. And the argument is that it completely undermines the whole point of self-custody and financial privacy.
So this is where the bill could get stuck. Does the source think this disagreement could actually derail the whole thing?
The takeaway is probably not. It will definitely slow things down. There will have to be huge compromises. And maybe they kick the can down the road on the toughest DeFi questions.
But it won't stop the bill entirely.
It's not expected to. The momentum behind getting clarity for Bitcoin and making exchanges safer is just too strong. That seems to be the part everyone agrees on.
Which brings us to the big picture. After all of this legislative detail, why does this matter so much right now?
Well, if we connect this to the bigger picture, this is the regulatory certainty that the entire industry has been begging for since, 2017.
Right.
The lack of clear federal rules has been the #1 thing stopping the big conservative money pension funds, insurance companies, from getting seriously involved in the U.S.
So the impact could be, well, it could be massive. The source lays out a few huge outcomes here.
The first one is the most obvious.
Yeah.
It would unlock billions, maybe trillions, in institutional capital that's just been waiting on the sidelines for a green light.
Okay, that's number one. What's two?
It gives Bitcoin and Ethereum that full, undeniable legal clarity. The threat of being called a security is just gone forever.
And from there, it snowballs, right? With clear definitions, it would almost certainly speed up ETF approvals for other assets.
Absolutely. And it forces all those exchanges to get safer with the FTX guardrails we talked about.
So when you add all of that up,
It legitimizes the entire American crypto economy.
yeah.
And it ends this whiplash we see every time a new administration comes in and decides to change the rules through enforcement. It creates a stable, predictable standard.
And just to remind everyone of the timeline, what are the dates we're watching?
The big one is December 2025. That's the Senate Banking Committee vote. If it passes, we're looking at a full Senate vote in early 2026. And from there, it goes to the president's desk.
So what does this all mean? When you boil it down, the U.S. is about to build its crypto market on 3 pillars. First, clarity for the big assets, which go to the CFTC. Second, safety for customers with those FTX rules.
And third, a big unresolved fight over the future of DeFi.
But the key is that we're moving from regulation by ambush to an actual rule of law, and that changes everything.
It does, and it has effects way beyond the U.S. So here's the final thought for you to think about. If the U.S. actually pulls this off, if it goes from being a laggard to a leader with this clear framework, how quickly will other global hubs, the EU, Hong Kong, Singapore, how quickly will they be forced to change their rules to compete for all this institutional money that's about to be unlocked?
The global regulatory race just got a whole lot more interesting. We'll be watching this as it develops. Thanks for joining us for this deep dive.